Max, I wrote two memos on the subject, one called Risk, aptly titled, I thought, in 2006, and one called Risk Revisited, and then Risk Revisited in 14, I think it was, and then Risk Revisited again in 15. So if people want to catch my thinking on risk, they should read the last one, Risk Revisited again. And I think that risk is not volatility. Risk is the probability of having a bad thing happen. And for most investors, that means the probability of permanently losing money. And if we have invested within our financial resources, not exceeded our financial resources, and if we have the emotional ability to hold on even when things get choppy, then volatility or instability is not our enemy. Our enemy is losing money. And of course, when volatility hits and prices drop, it's never clear whether that's a downward fluctuation, temporary in nature, or a permanent loss of money. And it's our job to try to figure out which is which. But for the most part, when people turn pessimistic and risk aversion soars and prices collapse in these crises that I mentioned having lived through, that's a reduction of risk. You see, the S&P went from 3,300 to 2,300. And the average investor says, oh, the market is so much riskier today. Well, I think the market is so much less risky. It's so much less risky to hold it when it's at 2,300 than it was to hold it at 3,300. And you know, I have experience and maybe enough cold-bloodedness to get excited and feel positive when prices drop. Most investors, of course, do the opposite and panic out. Buffett says, I like hamburgers, and when hamburgers go on sale, I eat more hamburgers. And I feel the same. And when the investments go on sale, I want to own more of them, not less. So now your question was about risk this time. I think this time was the greatest example of an exogenous factor at work. The coronavirus is not a financial element, and certainly it was unpredictable. And nobody would say, well, that guy was dumb. He didn't anticipate the coronavirus. You know, very few did. Gates, of course, warned about virus, and many scientists, but of course, nobody identified the coronavirus or said it was going to happen in the first quarter of 2020. Generalized warning is better than none, but it wouldn't have helped you much in the market. So what's the import of the fact that we couldn't expect to identify the coronavirus in advance? About 2001, I wrote a memo called You Can't Predict, You Can Prepare. And I heard this on TV during a football game. This was the advertising slogan of an insurance company. I think it was the Mass Mutual Insurance Company. And I thought it was brilliant. Now, superficially, it sounds dumb. You can't predict, you can prepare. How can you prepare for something you can't predict? But I think it's an essential insight. Even when you can't predict the thing that is going to affect the world, you can prepare for the arrival of risky elements. And when do you have to prepare? You have to prepare when the cycle is not on your side. And as I said before, when investors are optimistic and risk aversion is at a low and investors have a lot of money and investors are eager to put it to work, and as a consequence, asset prices are high, this is the time to prepare for a worsening of the environment, even though you can't predict what's going to make it happen. And to me, this purported oxymoron, you can't predict, you can prepare, makes perfect sense. So the point is, as I mentioned, we were defensive in recent years, our defensiveness allowed us to be prepared for an event that we did not predict. And now that the virus is here, and now that asset prices are lower, especially in our area of credit, we feel we were prepared, and now we're swinging more into action of investing.